You told yourself you were just going to check. That's all. Open the app, glance at the number, close it, but the number is green today and green feels good, so your thumb keeps scrolling. There's a list of what everyone else is buying. There's a little chart ticking up while you watch it, and somewhere in the next 90 seconds, without really deciding to, you've placed a trade. Confetti falls across your screen. You feel a small, bright hit of something. You felt it before. That feeling isn't an accident. It was designed, tested, and optimized by people who get paid every single time your thumb moves. So let's talk about the app that made this feeling famous. Robinhood launched in 2013 with one promise: zero commission trading, no fees. Wall Street had charged regular people $5, $7, $10 a trade for decades, and here was an app that made it free. Beautiful design, one tap to buy. It felt like the little guy finally had the same tools as the big guy. By 2021, Robinhood had more than 22 million funded accounts, and the median age of its users was 31. A whole generation learned to invest inside a green and white interface that felt more like a game than a bank, and that word, game, is the entire story. There's a question almost nobody stops to ask. If the trades are free, how does the company make billions? Robinhood went public in 2021, valued at roughly $32 billion. Free doesn't build that. Something you can't see is paying the bill. In this business, when you can't find the customer, it's usually because you are the product, not you exactly, your orders. Every time you tap buy or sell, that instruction to trade carries real value, and Robinhood sells it. The mechanism has a boring, deliberately forgettable name: payment for order flow. When you place a trade, Robinhood doesn't send it to a public exchange. It routes your order to a giant trading firm, a market maker like Citadel Securities. That firm fills your order, keeps the tiny gap between the buy price and the sell price, and pays Robinhood a cut for sending you its way. Citadel Securities handles an enormous share of all US retail stock trades. You never see it, you never meet it, but it's the actual customer here, and you're the inventory. In 2020 alone, Robinhood made about $687 million from selling order flow. The trades were free, you were the revenue. Regulators noticed. In December 2020, the SEC charged Robinhood for misleading customers about exactly this. The company had told users it offered the best prices, while quietly taking payments that the SEC found left customers worse off, costing them tens of millions in weaker execution even after the free trades. Robinhood paid $65 million to settle without admitting or denying the findings. Sit with that math. The firm earned hundreds of millions selling your orders, and the penalty for hiding it barely dented a single quarter. Yeah, a fine that small doesn't change how a company behaves. It just gets filed under the cost of doing business and forgotten by the next earnings call. This next part should make you at least a little angry. The UK's Financial Conduct Authority has effectively made payment for order flow illegal in the United Kingdom. Canadian regulators restrict it. The European Union voted to phase it out completely by 2026. Regulators in all those places looked at the same setup, broker paid by the firm on the other side of your trade, and decided it was too conflicted to allow. In America, it isn't just legal, it's the foundation the entire free trading industry is built on. The next time an app tells you trades are free, remember that the same business model is treated as a consumer protection problem across half the developed world. This is where it stops being a finance story and becomes a psychology story. Selling order flow only pays if you trade a lot. The more you tap, the more they earn. So the whole app is engineered to make you tap. Think about what greeted new users. Free stock handed over like a scratch-off lottery ticket, tap to reveal what you won. Confetti raining down after a trade, push notifications about stocks that are moving. Lists of the most popular buys, so you always know what the crowd is chasing. A number that flips bright green or bright red the instant markets open. Take that free stock offer apart for a second. Robinhood gave new users a random free share, revealed with a scratch-off animation, and dangled the idea that you could win stock worth hundreds of dollars. But the overwhelming majority of those free shares were worth just a few dollars each. The jackpot framing was the whole point. It wasn't a gift, it was a slot machine's first pull, the one the house lets you win, so you keep pulling. You didn't get an investment, you got trained. None of that helps you invest better. All of it is borrowed from a slot machine. Psychologists call it a variable reward schedule. When a reward is unpredictable, that sometimes you win, sometimes you don't, and you never know which. Your brain releases more dopamine chasing it than it would for a sure thing. It's the exact loop that makes gambling sticky. Pull the lever. Wait. Maybe. That flicker of maybe is the most addictive signal the human brain has, and a stock ticker delivers it every few seconds for free right there in your pocket. Robinhood didn't invent that loop, they just wired your savings into it. Now, this isn't a theory I'm spinning. In December 2020, Massachusetts securities regulators filed a formal complaint accusing Robinhood of gamification, using game-like features to nudge inexperienced investors into trading constantly. And there was a human cost that should stop you cold. In June 2020, a 20-year-old college student named Alex Kearns opened his Robinhood app and saw a balance that appeared to show he was $730,000 in the hole. According to his family and later reporting, that figure was a display error, a temporary number tied to an options position that was not his actual loss. In the note he left, he wrote that he believed he had taken on that debt without understanding what he was doing, and that he could not reach anyone at the company for answers. He died by suicide. Robinhood later settled with his family, added new guardrails, and built out phone support. The point isn't that an interface can end a life, it's that a product tuned for engagement with almost no human being behind it can be a dangerous place to hand someone young a high-risk financial instrument. If any of this hits close to home, please reach out. In the US, you can call or text 988 anytime. And the design works exactly as intended. During 2020, Robinhood's customers traded far more aggressively than customers at older brokerages. By one analysis, they traded roughly 9 times more shares than E-Trade users and around 40 times more than Schwab users, adjusted for account size. Same stock market, same public information. The only thing that changed was the interface. One was built to feel like investing. The other was built to feel like a game you could win right now. The design didn't just predict that behavior, it manufactured it. And Robinhood is just the one that got caught first. The playbook spread everywhere. Coinbase turned buying crypto into a rewards game, handing out free coins for watching short lessons. Learn and Earn, which trained millions of new users to associate tapping through its app with a payout. eToro built a social feed where you can literally copy the trades of strangers with one tap, complete with follow accounts and a leaderboard, turning retirement money into something that behaves like a fantasy sports league. The names and logos change, the psychology underneath never does. Once one company proves a game-shaped interface makes people trade more, every competitor has to copy it or lose. The gamification isn't a quirk of one bad app, it's the default wiring now soldered into every new brokerage that ships. Pre-installed under the buy button, humming whether you notice it or not. Follow the money one more step, because this is the part nobody spells out for you. Not every trade pays the same. When Robinhood routes a plain stock trade, that order flow is worth a little. When it routes an options trade, those complex high-risk bets on where a price is heading, it's worth a lot more. Market makers pay several times more for options order flow than they do for stocks, which means the app earns the most precisely when you trade the single riskiest product it offers. Look at Robinhood's own filings. In early 2021, options brought in more order flow revenue than stocks and crypto combined. The most dangerous thing you can do in that app is the most profitable thing for the app. That's the whole business model in one sentence. The house wins biggest when you make the worst bet. And the bets really are bad for you. This is the oldest, best documented finding in all of investing. 2 finance professors, Brad Barber and Terence Odean, studied thousands of real brokerage accounts. The households that traded the most earned about 11% a year, while the market returned closer to 18%. Trading more didn't beat the market, it roughly cut their returns in half. A separate study of day traders in Brazil, where the practices everywhere followed people who did it seriously for a year or more. 97% of them lost money. Practically every person who tried it seriously ended up in the red. The exact activity the app is built to maximize is the activity that reliably leaves you poorer. Compare that to how a boring index fund works, the kind financial planners actually recommend. You put money in, nothing flashes, there's no confetti when you buy, no notification begging you to sell, no leaderboard telling you how you rank. It's designed to be forgotten because the best thing you can do with a good long-term investment is ignore it for 30 years. Feel the difference? A tool built to make you richer is boring on purpose. A tool built to sell your order flow is exciting on purpose. Excitement isn't a feature for you, it's a feature for them. When your bank suddenly feels fun, ask who's paying for the party. From now on, here's how you see it. Yeah, every single time. When an app that handles your money adds a game, that game is not for you. And it's a meter that runs while you play. Your confetti, streaks, free stock lotteries, red and green pulsing at you, none of it is information. It's a nudge, and the nudge always points at whatever they earn the most from. The fix is almost insultingly simple. Add friction, turn off the price notifications, delete the app off your home screen so buying takes effort instead of a reflex. Decide your trades on a slow Sunday, not in a bright green moment when your heart's racing. Boring is the strategy. The people who designed the confetti are betting you can't sit still. Prove them wrong, now you see it.